Welcome to NN Investment Partners MaxTen, a series of one-on-one interviews with our investment experts in under 10 minutes. I'm Stephanie Broad, thank you for joining us. Today's guest is Joep Huntjens, Head of Asian Fixed Income at NNIP. Thank you for being here with us today, Joep.
Hello, Stephanie. Thank you for inviting me. I'm happy to answer all your questions.
And I have quite a few indeed, Joep, so let's kick off and let our 10 minutes together start now. Could you tell us about the investment opportunities in Asian debt?
Sure. First of all, Asia has been the fastest growing region in the world for many years. This stronger long-term growth rate presents a compelling argument for investing in Asian bonds. In addition to this longer-term growth trend, the current macroeconomic momentum is also very strong. Asia controlled the virus well, resulting in earlier and stronger recovery of economic activity. If we then look at the asset class Asian debt itself, US dollar bonds issued by Asian companies and governments, this is a rapidly growing asset class. Over the last 10 years, its size more than quadrupled and currently exceeds 1.2 trillion US dollar. Growth of the asset class comes with more size, so more opportunities, and also more diversity. Finally, despite Asia's superior growth outlook, valuations levels are compelling, with credit spreads substantially higher than comparable fixed income sub-asset classes, such as developed market corporate credit. So in short, the opportunity of Asian debt is strong growth of Asian economies, the increased size and diversity of the asset class, and attractive valuation levels.
And do you also see fundamental and technical factors supporting the asset class?
Yes, the strong growth recovery in Asia bodes well for profitability of the Asian corporate sector, and that is very supportive for corporate credit fundamentals. Another supportive factor, specifically for the fundamentals of the property sector in China, is the recent introduction of policy measures which limit the leverage of companies in that sector. Demand for this asset class has been consistently strong since the market started to recover from the global market sell-off in March last year. We expect that the attractive valuation level of this asset class, especially in a search for yield environment, will support demand for Asian bonds in the coming year.
Can you tell us about the risk-return profile of Asian debt?
Yes, Asia is a safe haven in emerging markets, which is reflected by the high credit ratings of Asian countries. In our investment universe, more than 75% of the bonds have an investment grade rating. The asset class is also less impacted by moves in interest rates, as it has a low duration. These factors, higher credit rating and lower duration, contribute to a lower volatility of this asset class, which makes the risk-return profile attractive.
So how do clients typically allocate to Asian debt?
Increasingly, investors are looking for dedicated allocations to Asia, both in equity and in fixed income. China is a big driver of that move. As regulations such as capital flows, foreign investor access, currency regulations, and credit rating frameworks can differ across local credit markets, for international investors, the offshore US dollar denominated Asian credit market is the easier and more accessible route to gain Asian fixed income exposure. Our Asian debt fund does, however, also provide opportunistic access to Asian local currency debt. What we also see is that clients generally are aware of the opportunities in Asia, but often struggle to find where they can incorporate it into their portfolios. It's often not taken into account as a separate asset class in allocation processes. Therefore, it's often included as part of their EMD or global credit allocations.
So for investors making an allocation into an actively managed Asian debt fund or an index fund, what are the most important things they need to consider?
Especially for the high yield rated bonds in the universe, you don't want to be invested in those just because they are included in a benchmark. These bonds require proper credit analysis before you buy them, and that is a crucial part of the investment process of an actively managed fund. Another reason why passive management is less suitable for this asset class is the fast growth and rapid change of the composition of the investment universe. This dynamic nature of the asset class leads to relatively high trading costs for passive solutions that replicate the index.
Can you tell us why investors should select NNIP as their Asian debt manager?
Yes, I think there are several factors to consider. First, the team. We have a highly experienced team of 10 investment professionals, all based in Singapore. Then secondly, the strong and long-term track record. When we started managing this asset class 25 years ago, we were one of the first to do so. And then finally, the way we work, a structured investment process that is tested in many different market circumstances with a strong focus on fundamental credit analysis, including ESG analysis.
You stressed the integration of ESG factors in the investment decision. Why is this so important?
Well, ESG profiles of Asian companies are generally weaker and ESG data availability more challenging compared to Europe, for instance. However, things are improving in Asia, and we expect this trend of stronger ESG profiles and better ESG data availability to continue. This trend is driven by investor focus on ESG considerations and requirements from regulators. Increased investor focus on ESG practices should ultimately lower the cost of capital for issuers that manage this transaction best and lead to a more sustainable world. We believe that a detailed ESG analysis process is justified in Asia even more than it is in developed markets, and we use two tools for our ESG assessment. First of all, the NNIP ESG Lens, which is an objective, reliable and unique technology-based tools for ESG analysis. It's based on the combination of human and machine input, big data and data based on company policy, and takes both slow-moving and fast-moving data into account. And secondly, another tool we have is the EMD Corporate ESG Scorecard, which enables analysts to conduct an in-depth manual analysis of those companies that have previously faced controversies or that may initially appear to have a weaker ESG profile. Now, our structured and detailed ESG analysis approach helps us to identify companies with poor or deteriorating ESG profiles, and that helps to mitigate downside risk. On the other hand, it also helps to select issuers which take ESG factors more seriously, and more importantly, to show improvement. An example of that was a Chinese property developer which reported several fatalities and injuries resulting from accidents, in itself a sign of weak ESG practice. However, after a dialogue with the developer, we were convinced that the company took this accident very seriously. They halted the construction of their projects nationwide, and that it had taken measures to ensure improved work safety in the future. This confirmed our view that the ESG profile of the company was strong and improving, which is something we take into account in our investment decisions.
So what are your expectations for Asian debt for the next few years?
We believe the strong growth in Asia and China will continue, and investors will increasingly allocate to opportunities in Asia. Although the asset class continues to grow in size, it is maturing and has become more of a mainstream asset class, and that should lead to a reduction of the risk premium that is paid for the asset class. And finally, we expect further development on environmental issues. China's 2060 carbon neutrality pledge will drive focus on environment, and will force companies to further develop environmental policies and ambitions. We can also look at this the other way around. Investors focus on ESG, including engagement efforts, increasingly stimulate companies to take action on ESG-related topics.
Thanks, Joep. A strong outlook indeed. But I hear you're celebrating a 25-year anniversary with NNIP. Could you tell me what it is that's made you stay in the industry?
Yes, 25 years, that's a long time indeed, but this industry is always is very dynamic and always evolving, and especially in Asia, things are moving really fast. So it doesn't feel like 25 years, and I'm still enjoying it every day.
Well, that's really good to hear. But for today, our 10 minutes stop now. Thank you, Joep, for this insightful Q&A.
You're welcome. It has been my pleasure.
And thanks also to you for watching. I hope you enjoyed today's discussion as much as I did. See you next time for NNIP MaxTen. Don't miss it.